Back at 7:44, the Federal Reserve met yesterday and decided to hold interest rates steady. President Trump has been pressuring the central bank to cut rates. While that decision affects the economy broadly, it can have a big impact on the stock market as well. Financial advisor from Ernie Burns, from Burns Financial, Ernie Burns is here with us this morning to explain. But Ernie, good morning. Before we get into what happened yesterday, let's talk about what was announced this morning. And on Truth Social, President Trump said he wants to nominate former Federal Reserve Governor Kevin Warsh to be the next Fed chair. What can you tell us about that potential ascension to that position for him?
Well, they don't expect him to be wrapped around anybody's finger, and the markets actually went positive for a short period of time once he was nominated. So it's basically steady as we go. We don't see any big rockets in the market. Okay,
let's get back to what happened yesterday at that meeting. We were expecting them to vote to hold those rates steady, and that's what they did. So,
yes.
So what does that mean exactly? Well,
it tempers the market. The market, that's what they believed was going to happen. Right now, we're looking at a 1 to maybe 2 rate deductions this year, cuts, which would be great. Possibly another late in the quarter, but here's the deal. Right now, there's so much burn in the economy. We're expecting a very bullish market this year.
So, talking to our viewers this morning, if they are people who are retirees or about to hit that point in their lives, what should yesterday's decision mean for them?
Again, steady as you go. In other words, if you're about to retire, then you need to be pull back risk anyway, no matter who's the Federal Reserve might be. You need to pull back your risk, look at fixed income, because since he didn't lower rates, say income rates a little bit higher for fixed income bonds, CDs, things of that nature, structure notes. If you're not going to retire for a couple of years, say 2 years out, you can still be kind of bullish right now because we're expecting the economy to really take off.
And let's talk about the rates, these higher rates or rates staying on the higher side can mean when it comes to investing. Is it kind of a similar idea there?
Yes. Our belief is if the rates are staying steady, the market's going to be fine. If they keep dropping rates, it should spur the market. The weird thing about it is that means the economy is slowing down. That's why they're lowering rates. So we don't want the economy to slow down, but we also don't want inflation to creep in. So it's a very healthy balance, I guess.
An interesting thing to try to balance out there. Yeah. So obviously that was the first meeting of the Fed for 2026. Several other meetings happening down the line. So what's the big takeaway that you have, that you want our viewers to take away from what happened yesterday?
Just be very selective on how you invest. Okay. Especially if you're looking at retirement, like you said earlier, within the next 2 years or sooner. Be very selective how you invest. And from there, if you're sitting down with an advisor, make sure you build an income plan and a tax strategy plan. It's very, very important.
All right, Ernie Burns, as always, we appreciate your time.
Thank you.
Stay warm this weekend.
No worries.
Zach Fradella says it's about to drop. Talking about the temperatures. Let's get